If you have money in the market right now, here's what you need to know. We just closed out the fourth consecutive losing week, 4 weeks of red. But hold on, that is just the opening act. Because the Nasdaq, the index that tracks the biggest technology companies on the planet, just officially crossed into correction territory. More than 10% wiped off its peak. That is a meaningful threshold. Wall Street pays attention when that number gets hit. But even that is not what has experienced investors rattled right now. Here is the part that makes no sense on paper. Gold, the asset that every financial advisor, every economist, and every market historian will tell you goes up when inflation is rising, when a recession is building, and when wars are breaking out, just recorded its worst single week since 1983. We have all three of those conditions active right now, simultaneously, and gold crashed anyway, not dipped, crashed, fastest drop in over 4 decades. Something is wrong with this picture, and if you do not understand what is driving it, your money is at risk. That is exactly what we are unpacking today. What is happening with gold, what is happening with the broader economy, and what you as an investor need to have on your radar right now. Because the situation is evolving fast, and every piece of this connects to the others. Stay with me through the full video, because every section builds on the last one, and you need the complete picture. Before we get into why gold crashed, you need to understand the track record, because that is what makes this week so jarring. Go back to September 2001, the worst attack on American soil in a generation. Gold jumped. Go back to 2008. The entire global financial system nearly collapsed. Gold climbed while stocks were in freefall. Go back to early 2020. A global pandemic shut down entire economies overnight. Gold hit all-time highs. The pattern is that consistent. Crisis happens. Money moves into gold. Price goes up. It is held across every major shock in living memory because gold cannot be printed, cannot be devalued by a government decision, and does not depend on any company's earnings to hold its value. When trust in everything else breaks down, gold is what people reach for. Now, look at what we have right now. Inflation that is documented and accelerating. Recession risk that has moved from fringe concern to mainstream economic conversation. And an active military conflict in the Middle East that is directly threatening global energy supply. 3 simultaneous triggers. Every one of them has independently driven gold higher in the past. All 3 active at once should be the most bullish setup for gold that any investor has seen in decades. And gold just posted its single worst week since 1983. Something has changed, something big. And there are 2 specific forces driving this. Both of them matter far beyond just the gold market itself. Here is a number that tells you everything about how dramatically the situation has changed. 0. That was the probability assigned by interest rate futures markets just a few months ago that the Fed would raise rates in 2026. 0. Not unlikely, not remote. 0%. The entire debate in financial circles was about the pace of rate cuts. How many? How fast? Would the Fed cut twice before summer? 3 times total? The White House was pushing for lower rates. The Fed itself was telegraphing lower rates. Every major bank's 2026 forecast was built on that foundation. Then the Middle East escalated, and that foundation broke. The same futures markets that assigned 0 probability to a rate hike are now pricing in a real possibility of the Fed raising rates before December. Analysts who would not have entertained that scenario 3 months ago are now publishing research notes about it. The Fed chair himself confirmed at the most recent meeting that the original plan of multiple cuts has been walked back to maybe 1. Maybe. But Wall Street is not even granting that much. The market consensus outside the Fed building right now is 0 cuts in 2026. And a growing number of voices are saying the next move could be up. Why does this specifically hurt gold? A rate hike strengthens the dollar. A stronger dollar makes gold less attractive because gold is priced in dollars and generates no yield on its own. The moment investors started pricing in the possibility of higher rates, the case for holding gold weakened. Why sit in something that pays you nothing when the dollar itself might be about to get stronger and start earning you real returns? That logic triggered the sell-off. But reason number 2 goes somewhere most investors are not looking. Here is something most financial commentators are not telling you right now. The thing that is really driving this gold sell-off is not just about interest rates. It is about what governments do with their gold when they run out of money to fight a war. In the early 1980s, during the last major Middle East conflict that overlapped with a serious inflation crisis, the OPEC nations financing those military campaigns eventually hit a wall. War is expensive, extremely expensive. And when national treasuries start running low, governments look for liquid assets they can convert to cash quickly. Gold is at the top of that list. Several of those nations started selling their gold reserves in volume to keep operations funded. When sovereign-level sellers hit a market simultaneously, prices fall. That is not complicated. More supply than demand means lower prices. Every asset class works the same way. Now, connect that to today. The two-part historical setup that preceded that gold selling is almost identical to what we are living through right now. In the early 1970s, the United States had an inflation crisis rooted in Nixon taking the dollar off the gold standard. Then, a Middle East conflict ignited on top of that inflation problem. OPEC cut oil supply. Energy prices spiked. The inflation problem that already existed got dramatically worse. The Federal Reserve responded by hiking rates until mortgages hit nearly 20%, 18% to buy a house. Today, pandemic inflation shock. Then, Middle East conflict on top of unresolved inflation. Oil prices rising, same sequence, different decade. The question every serious investor is now asking is whether the third act of that playbook is about to repeat. The part where the countries funding the war run low on cash and start liquidating gold to cover it. If that happens, the supply side of the gold market shifts dramatically, and prices do not just stall, they fall hard. Let me explain how Iran decided to fight back, because this framing matters. A month ago, the United States hit Iran with military strikes. Iran assessed its options. A direct conventional military response against the most powerful armed force on the planet was not a viable strategy. So they chose a different battlefield, not a military one, an economic one. And the weapon they reached for was the one thing they control that the rest of the world needs: energy. Here's how they deployed it. The Strait of Hormuz is a narrow waterway in the Persian Gulf. It handles roughly 20% of the entire world's oil supply in daily transit. There is no practical bypass for tankers moving petroleum out of the Gulf region. It is a geographic choke point with no substitute. Iran shut it down. Oil is not flowing freely through that passage. A fifth of the global oil supply cannot get from where it is produced to where it needs to go. On top of that, Iran went after the production infrastructure itself: oil refineries, processing facilities, the upstream machinery that turns crude into usable fuel products. The goal is not only to block what has already been extracted, it is to reduce how much gets extracted going forward. Think about what higher oil does to an economy like ours. It is not just your gas bill, it is the input cost, sitting underneath almost everything that gets made or moved in this country. Higher oil means higher diesel. Higher diesel means every truck on every highway costs more to run. Every grocery store, every hardware store, every warehouse in America absorbs that cost. And they pass it on to you. Iran engineered this deliberately. They identified the lever that could create the most sustained economic pain without requiring a single direct military engagement. And it is working. The damage is already showing up in the data. Picture a doctor treating a patient with two competing conditions. One condition requires medication that raises blood pressure. The other requires medication that lowers blood pressure. The doctor cannot administer both at once. Whichever one gets treated, the other gets worse. That is the exact situation the Federal Reserve is in right now. Higher interest rates are how you fight inflation. You tighten money, raise the cost of borrowing, slow down spending, cool prices. It works. But it also slows the economy and can tip a fragile situation into a full recession. Lower interest rates are how you fight a recession. You make borrowing cheaper, stimulate investment and spending, get hiring moving again. It works. But it also adds fuel to inflation because more dollars chasing the same goods means prices rise faster. The textbook assumption is that you need one or the other at any given moment, not both simultaneously. Inflation and economic weakness tend to arrive in different phases. The Fed tightens when the economy is overheating. The Fed loosens when the economy is cooling. One prescription at a time. Right now, both conditions are active and worsening at the same time. Inflation was already trending upward in the data before the first military action in the Middle East. Now, with the Strait of Hormuz blocked and energy infrastructure under attack, that inflation pressure has another engine behind it. Meanwhile, the GDP numbers are weakening. Consumer spending is pulling back, and there is a structural shift that did not exist in any previous version of this scenario. Artificial intelligence is eliminating jobs at a pace that is now visible in employment reports. Companies are growing revenue with smaller headcounts, more output, fewer paychecks in circulation. That is a new kind of economic pressure that no historical Fed playbook was designed to address. The chairman confirmed the bind at the most recent meeting. Multiple cuts in 2026 are off the table. Now it is maybe one, but Wall Street is not granting even that. 0 cuts is now the base case, and a rate hike before December is being discussed openly by analysts who would not have touched that scenario 3 months ago. There is one more variable in this picture that deserves its own discussion, because it could change how the Fed responds to everything we just covered. In May 2026, Jerome Powell's term as Federal Reserve Chairman expires. The plan, as things currently stand, is for him to be replaced by Kevin Warsh. Warsh is someone the Trump administration believes will pursue aggressive rate cuts once he takes over. The expectation from the White House is that a Warsh-led Fed will bring interest rates down quickly and significantly. Now, there is legal turbulence around that transition. Active lawsuits have introduced real uncertainty about whether the handover proceeds as planned. But if Warsh does take the chair in May, the entire monetary policy picture shifts. Here is why that matters so much right now. Everything coming in from the data points toward a Fed that should be holding rates steady at minimum and possibly preparing to raise them. The inflation dynamics, the oil price shock, the historical precedent from the 1970s, all of it points toward tighter policy. Stronger dollar, slower economic velocity to break the inflation spiral. But a Warsh-led Fed operating under direct political pressure to cut rates could go in exactly the opposite direction. If rates get cut aggressively at the same moment that oil-driven inflation is building, the dollar weakens, import costs rise, prices that were already moving in the wrong direction accelerate further upward. And the inflation problem, which was already the single biggest threat to ordinary American households before any of this started, gets materially worse. This is the X factor, the variable that makes it genuinely difficult, even for the most sophisticated Wall Street analysts, to model the next 6 to 12 months with confidence. The policy question is no longer a purely economic calculation. It is wrapped up in a leadership transition, political pressure, and legal proceedings simultaneously. What is certain is this: the person sitting in that chair by mid-2026 will have more direct influence over your interest rates, your mortgage costs, the purchasing power of your dollar, and the performance of your investments than almost any other single factor in the economy right now. Now, let us bring all of this directly home, because understanding what is happening only has value if it helps you make smarter decisions with your money. Honest starting point. Nobody knows exactly how this plays out from here. Nobody knows when the Middle East situation stabilizes. Nobody knows what the Fed does next, or how far the market falls before it finds a floor. Anyone giving you certainty on those questions right now is not being straight with you. But here is what the historical record makes clear. When markets fall hard and fast, they create the most powerful buying opportunities available to long-term investors. That is 100 years of documented market history. And the investors who are prepared for that moment, who understand the pattern and act on it with discipline instead of fear, are the ones who come out on the other side with significantly more wealth than they started with. I use a framework called POOP. The name is intentional because memorable beats forgettable every time. POOP stands for Panic Leads to Overselling, which creates opportunity, which leads to profit for the financially prepared. Here is how it always plays out. A real crisis hits. A justified decline begins. Then emotions take over. Investors without a clear strategy start selling, not because anything fundamental has changed about the quality of their investments, but because the headlines are terrifying and the psychological pain of watching a falling balance becomes too much to tolerate. That wave of emotional selling pushes prices below what the underlying assets are actually worth, and that gap is where opportunity is created. 2022, market fell 20%. The investors who saw the poop bought at discounted prices and captured the recovery. 2020, market fell 35%. The investors who stepped in during that collapse saw dramatic gains in the 18 months that followed. 2008, market fell between 30 and 50%. The investors who loaded up on quality assets during the worst of it built substantial long-term wealth. 2000 to 2001. The dot-com collapse sent internet stocks down 78%. The investors who recognized the poop came out of that decade in a completely different financial position. Every one of those moments felt catastrophic while it was happening. Every single one turned out to be one of the best buying opportunities of its era. So, what does the practical move look like right now? If you are a passive investor, the strategy is straightforward and it does not require you to watch the market every day or make high-pressure calls in real time. I call it ABB, always be buying. You build a consistent system. Every week, every 2 weeks, every month, you invest a set amount into your chosen diversified assets regardless of what the market is doing on any given day. You do not chase the exact bottom. You do not wait for the news cycle to turn positive before you restart. You stay consistent. The only adjustment you make is when prices drop hard. And when that happens, you put more in, not less. Because falling prices mean each dollar you invest is buying more ownership in the assets you are building. That is dollar cost averaging working exactly as it should. If you are an active investor, this environment is one of the most productive setups you will see for building wealth faster than a calm rising market ever allows. The volatility creates dislocations where quality assets get dragged down alongside weaker ones because panicked selling is not selective. That indiscriminate selling is your window. Now is when you do the research. Which businesses have the pricing power to protect their margins when input costs rise? Which sectors benefit when oil is expensive and the dollar is moving? Which companies are structurally positioned to come out of this stronger than they entered it? But patience is the most critical quality in this environment. The volatility over the last few weeks is not the tail end of this disruption. Based on the factors driving it, the geopolitical conflict, the monetary policy uncertainty, the inflation trajectory, the structural employment shifts from AI, we are much closer to the beginning than the end. We do not know how long this lasts. We do not know how bad the inflation problem gets. We do not know when this war ends. But what history tells us over and over is this. Market downturns and recessions have created more long-term millionaires than any other environment because they make quality assets temporarily cheap. And the investors who stay calm, execute their strategy with discipline, and keep accumulating while everyone else is reacting out of fear, those are the investors who look back on this period as the moment that changed their financial trajectory. Stay calm, know your strategy, find the opportunity. That is how the financially prepared operate. And if this video gave you value, the best way to say thank you is a referral. Share it with someone in your life who needs to hear this right now. Financial education is the most powerful investment anyone can make, and spreading it is how we all come out of this stronger. And stay tuned, because President Trump just confirmed something that could fundamentally change the financial picture for every working American. He wants to eliminate the income tax entirely, replace it with tariff revenue. Here is what he actually said. He said he believes tariffs paid by foreign countries will substantially replace the modern income tax system and take a great financial burden off the American people. Now think about what that actually means for your paycheck, for your business, for the inflation picture we have been talking about throughout this entire video. Because if the income tax goes away and tariff revenue becomes the primary funding mechanism for the federal government, the downstream effects on prices, on the dollar, and on your investments are massive. Is it mathematically possible? What would it mean in practice for ordinary Americans? We are breaking all of that down in the next video. Make sure you are subscribed and have notifications turned on so you do not miss it when it drops.